Analyzing data for algorithmic trading with precision.
Algorithmic trading, also known as algo trading, is the use of computer programs and mathematical models to execute trading orders automatically, based on predefined criteria and strategies. Algorithmic trading can offer many advantages over manual trading, such as speed, accuracy, efficiency, and reduced human error. However, algorithmic trading also poses many challenges, especially when it comes to data analysis. Data is the foundation of any algorithmic trading system, and it needs to be handled with care and precision. In this video, I will discuss 3 key points to consider when analyzing data for algorithmic trading, and provide some examples of how to apply them in practice.
Point 1. Quality over quantity. Clean, accurate data is the lifeblood of algorithmic trading. One of the most important aspects of data analysis for algorithmic trading is the quality of the data. Quality refers to how reliable, consistent, and relevant the data is for the trading objectives and strategies. Poor quality data can lead to inaccurate signals, false alarms, missed opportunities, and increased risks. Therefore, it is essential to ensure that the data is clean and accurate before using it for algorithmic trading. Cleaning data involves removing or correcting any errors, outliers, duplicates, missing values, or inconsistencies that may affect the analysis. For example, if the data contains erroneous prices, volumes, or timestamps, they need to be fixed or discarded. Accurate data means that the data reflects the true state of the market and the trading instruments, and that it is updated and synchronized with the latest information. For example, if the data is delayed, stale, or incomplete, it may not capture the current market dynamics and trends. One way to ensure data quality is to use reputable and reliable data sources, such as exchanges, brokers, or data vendors, that provide high-quality data feeds and services. Another way is to use data validation and verification techniques, such as cross-checking, backtesting, or auditing, to detect and correct any data issues. A third way is to use data cleansing and pre-processing tools, such as filters, transformations, or normalizations, to improve the data quality and format. Example: a trader wants to use a moving average crossover strategy to trade the EUR/USD currency pair. The strategy involves buying when the 50-day moving average crosses above the 200-day moving average, and selling when the opposite occurs. The trader needs to use daily price data for the EUR/USD pair from a reliable data source, such as a forex broker or a data vendor. The trader also needs to check the data for any errors, outliers, or missing values, and correct or remove them if necessary. The trader can then use the data to calculate the moving averages and generate the trading signals. Point 2. Visualize, don't just analyze. Graphs and charts provide insights beyond raw data.
Another important aspect of data analysis for algorithmic trading is the visualization of the data.
Visualization refers to the graphical representation of the data, such as charts, plots, or diagrams, that can help to understand, explore, and communicate the data. Visualization can offer many benefits over raw data, such as it can reveal patterns, trends, relationships, or anomalies that may not be obvious from the numbers alone. It can simplify and summarize complex or large amounts of data in an intuitive and concise way. It can enhance the interpretation and comprehension of the data and the analysis results. It can facilitate the comparison and evaluation of different data sets, variables, or scenarios. It can support the decision-making and the execution of the trading actions. Therefore, it is advisable to use visualization techniques to complement and enhance the data analysis for algorithmic trading. There are many types of visualization techniques that can be used for different purposes and data types, such as line charts, bar charts, or candlestick charts to show the price movements and trends of the trading instruments over time. Histograms, box plots, or scatter plots to show the distribution and variation of the data values or the trading performance metrics. Heat maps, pie charts, or tree maps to show the composition and proportion of the data categories or the trading portfolio allocation. Indicators, oscillators, or overlays to show the technical analysis and the trading signals of the trading instruments. Dashboards, tables, or reports to show the summary and the details of the data and the trading outcomes. Example: a trader wants to use a momentum strategy to trade the S&P 500 index.
The strategy involves buying when the index is above its 10-day moving average and selling when it is below. The trader needs to use daily price data for the S&P 500 index from a reliable data source, such as an exchange or a data vendor. The trader can then use a line chart to visualize the price movements and the moving average of the index over time. The trader can also use an indicator, such as the Relative Strength Index, RSI, to measure the momentum and the overbought or oversold conditions of the index. The trader can then use the chart and the indicator to identify and execute the trading opportunities.
Point 3. Continual data refinement. Regularly update and optimize your datasets for peak performance.
A third important aspect of data analysis for algorithmic trading is the continual data refinement. Refinement refers to the process of updating and optimizing the data sets and the data analysis methods to improve the trading performance and efficiency. Refinement is necessary because the market conditions and the trading objectives and strategies may change over time, and the data and the analysis need to adapt accordingly. Refinement can involve several steps, such as adding or removing data sources, variables, or features to increase the data coverage, diversity, or relevance. Applying or modifying data transformations, normalizations, or aggregations to enhance the data quality, format, or granularity. Testing or validating different data analysis techniques, models, or parameters to find the best fit, accuracy, or robustness. Evaluating or comparing different data sets, scenarios, or outcomes to measure the trading performance, risk, or profitability. Reviewing or revising the data analysis results, insights, or recommendations to align with the trading goals, constraints, or preferences. One way to perform data refinement is to use data feedback loops, which are cycles of data collection, analysis, action, and evaluation that can help to learn from the data and the trading experience, and to adjust and improve the data and the trading accordingly. Another way is to use data optimization techniques, such as genetic algorithms, neural networks, or machine learning, that can help to find the optimal or near-optimal solutions for the data analysis and the trading problems. Example: a trader wants to use a mean reversion strategy to trade the U.S. Treasury bonds. The strategy involves buying when the bond yield is below its historical average and selling when it is above. The trader needs to use daily yield data for the U.S. Treasury bonds with different maturities, such as 2-year, 5-year, 10-year, and 30-year, from a reliable data source, such as the U.S. Department of the Treasury or a data vendor. The trader can then use a data feedback loop to refine the data and the strategy, as follows. Collect the yield data and calculate the historical average and the standard deviation for each bond maturity. Analyze the yield data and identify the deviations from the historical average and the trading signals for each bond maturity. Act on the trading signals and buy or sell the bonds accordingly. Evaluate the trading results and measure the performance, risk, and profitability of the strategy for each bond maturity. Review the data and the strategy and decide whether to add or remove any bond maturity, change the historical average or the standard deviation, or modify the trading signals or the trading rules. Conclusion: data analysis is a crucial component of algorithmic trading, and it requires careful and precise handling of the data. In this video, I have discussed 3 key points to consider when analyzing data for algorithmic trading, and provided some examples of how to apply them in practice.
These points are: quality over quantity. Clean, accurate data is the lifeblood of algorithmic trading. Visualize, don't just analyze. Graphs and charts provide insights beyond raw data. Continual data refinement. Regularly update and optimize your datasets for peak performance. I hope that this video has been informative and helpful for you, and that you can use these points to improve your data analysis and your algorithmic trading. If you have any questions, comments, or feedback, please feel free to contact me. Happy trading!